Silver did not suddenly grab headlines by chance. It grabbed them because a daring forecast met a shaky market. When Robert Kiyosaki speaks about silver hitting $200, investors pay attention, not because his track record is flawless, but because his statements land when nerves are already frayed. At this moment, silver sits directly in that anxious territory. Let's establish the facts before emotions take over. Compared to the previous session, silver remains steady after violent swings. The price has not crashed, but it has not settled either. That alone should trigger caution. Markets that shift aggressively and then freeze are not recovering. They are calculating their next move. Now step back and observe the bigger picture. Compared to 12 months ago, silver operates in an entirely different environment. Last year, silver was gathering strength. This year, silver is managing overflow. That difference is critical. Last year represented exploration. This year represents absorption. Silver has already completed the difficult task of repricing itself upward. Now it faces the fallout from that adjustment. This is where forecasts like $200 silver turn hazardous if interpreted poorly. Not because the figure is unrealistic, but because timing determines everything. Silver does not climb like a smooth elevator. It climbs like a staircase with gaps. Investors do not stumble because the target is incorrect. They stumble because they move when support is absent. Kiyosaki's forecast functions like fuel poured on an already heated engine. It boosts acceleration, not steadiness. That is the core alert. When silver advances too quickly, too dramatically, hope overtakes logic, and markets make those who lose balance pay dearly. This year versus last year, turbulence has widened considerably. Daily price swings are broader. Corrections cut deeper. Rebounds snap back faster. That reveals silver is under strain, not fading from importance. Strain does not equal fragility, but it does equal danger. Picture silver as a pressure vessel without a reliable safety valve. As long as temperature climbs, the lid shakes violently. That shaking is what observers witness right now. Kiyosaki's $200 prediction adds more temperature. It does not eliminate uncertainty. The challenge is not about optimism itself. The challenge is about how traders position themselves. Many hear an ambitious number and believe timing becomes irrelevant. That enduring through anything becomes the winning approach. Silver does not validate that philosophy. Silver compensates patience and destroys inflexibility. Compared to last year, borrowed capital in silver markets has increased. Involvement has broadened, and predictions have grown louder. That mix breeds vulnerability. This is where the underlying framework becomes important. Silver trades in smaller volumes than gold. Its available liquidity is thinner. Its double purpose as both metal and money makes it more sensitive. When confidence strengthens, silver rockets upward. When confidence fractures, silver plunges harder than anticipated. This explains why silver can appear to abandon its supporters even when the fundamental narrative remains unchanged. It is not abandonment. It is simply how the system operates. Kiyosaki's statement should be viewed like a storm warning, not a scheduled appointment. It indicates rough conditions may arrive. It does not specify when circumstances will shift. At present, the silver market is not positioned for effortless gains. It is positioned for disorder. That does not cancel optimistic possibilities, but it absolutely cancels carelessness. Compared to yesterday, silver still carries tension. Compared to last year, silver runs too hot. Compared to 10 years back, silver functions within a radically altered demand landscape. These realities can exist simultaneously. This is why alerts matter at this juncture. Not alerts predicting total failure, alerts warning against misreading the situation. Silver can ultimately climb much higher and still inflict serious damage during the journey. That represents the hidden trap. The error lies in believing a bold prediction guarantees a direct route. Silver never travels in straight paths when too many expect the same outcome. And right now, expectations are densely packed. The market is losing depth beneath the surface. Liquidity retreats when chaos increases. That is when unexpected drops materialize, not because underlying value vanishes, but because equilibrium shatters. This creates the testing ground where silver challenges composure. If someone holds silver positions today, the crucial question is not whether $200 remains achievable. The question is whether they comprehend what silver does before arriving there, because the journey is where most participants surrender their confidence, their money, or both. This is not the time for unquestioning faith. It is the time for sharp awareness. And that understanding leads directly to the next critical concern. If ambitious forecasts inflate expectations, and if turbulence punishes weak positioning, then what truly drives these abrupt collapses in silver prices? The destruction silver brings after bold predictions is not rooted in psychology. It is rooted in pure mechanics. This distinction is where most analysis completely misses the mark. Silver does not collapse because faith evaporates. It collapses because borrowed positions snap under pressure. To grasp this reality, one must examine how silver actually functions in live markets. Unlike gold, silver futures demand significantly less upfront capital per dollar of market exposure. That feature naturally draws traders using leverage. Historical data shows silver typically moves 1.5 to 2 times faster than gold in either direction. This is not speculation. It represents verified behavior spanning multiple decades. When silver rallies with force, margin utilization climbs sharply. When margin utilization climbs, hidden risk accumulates in the shadows. That silence creates the perfect trap. One undeniable reality stands out here. The futures market for silver dwarfs annual physical production by enormous multiples. That means price formation happens predominantly in paper contracts first, not in storage facilities, not in manufacturing plants. When margin requirements jump or volatility explodes, paper holdings unravel at breathtaking speed. Physical demand does not evaporate, but paper-driven pressure crushes price in compressed timeframes. This explains precisely why silver can plummet violently even while factory demand stays robust. Now, connect these mechanics to current conditions. Compared to 12 months prior, silver trading activity has surged noticeably. Open interest expanded dramatically throughout the upward phase. That expansion confirms something critical. Participation grew, not merely price. More participants translate directly into more leverage. More leverage translates directly into more systemic fragility. This is where Robert Kiyosaki's bold statement intersects with market reality. When prominent voices broadcast large upside projections, speculative interest multiplies. Not all of that interest acts recklessly, but portions of it definitely do. That additional wave of participation inflates open interest and margin exposure substantially. It adds zero physical metal to the equation. This breeds dangerous imbalance. Think of this dynamic like loading additional vehicles onto a bridge without strengthening its foundation. The final destination becomes meaningless if the structure cannot bear the weight. Silver's bridge is exceptionally narrow. Another verifiable dimension involves supply fundamentals. According to published Silver Institute data, global silver supply has consistently fallen short of demand in recent years, driven primarily by industrial consumption. Solar technology, electronics manufacturing, and electrification infrastructure are not discretionary sectors. They represent mandatory demand. But supply shortfalls do not shield price from leverage-triggered sell-offs. They only determine the character of recovery afterwards. This is where countless investors confuse direction with timing. Silver can face structural undersupply and still endure savage drawdowns. Those drawdowns are not paradoxes. They represent how the system recalibrates itself. Now compare this year against last year once more. Last year, silver's ascent began gradually and methodically. Participation accumulated slowly over time. This year, momentum compressed and accelerated dramatically. That acceleration squeezes time itself. When time compresses, market reactions intensify exponentially. This explains why corrections now feel far more brutal than last year's pullbacks. The market carries substantially more internal tension. Another documented element is volatility measurement. Measured volatility in silver has expanded significantly compared to the previous 12-month period. Wider daily trading ranges confirm this unambiguously. High volatility environments reward those with patience, but absolutely devastate those using leverage. This is where the warning transforms into something actionable. If someone hears $200 silver and assumes they can safely ignore volatility patterns, they fundamentally misunderstand silver's nature. Silver does not trend smoothly when volatility operates at elevated levels. It whipsaws violently. It overshoots targets dramatically. It reverses without warning. This is why margin-driven liquidation typically surfaces at the most psychologically painful moment possible, immediately after optimism reaches its peak. The sell-off does not represent judgment on silver's long-term trajectory. It represents forced correction of overcrowded positioning. This also explains why long-term holders and short-term speculators experience silver through completely different lenses. Long-term holders measure time in years and decades. The market itself operates in milliseconds. When those two time frames collide violently, price action becomes savage. Another verified reality involves liquidity distribution across regions. Silver liquidity is not evenly spread across global markets. Certain trading hubs hold substantially more deliverable metal than others. When stress hits the system, price reflects the weakest link in the chain, not the strongest. That is why silver behaves like a geological fault line. Pressure builds quietly beneath the surface, then it releases abruptly without warning signals. Kiyosaki's prediction amplifies expectations dramatically. Expectations amplify positioning aggressively. Positioning amplifies systemic risk exponentially. That chain reaction matters far more than the number itself. If leverage resets explain the speed of silver's falls, supply fundamentals explain why those falls never last indefinitely. This represents the piece most observers completely fail to grasp. Supply strain does not eliminate volatility from the equation. It determines what unfolds once volatility exhausts itself. Silver is not merely a trading instrument. It is a functioning industrial metal with irreplaceable properties. More than half of worldwide silver consumption flows directly into industrial applications. That stands as a verified, long-established reality documented consistently by the Silver Institute, solar panel manufacturing, electronic component production, electric vehicle technology, data center infrastructure. These industries do not halt operations because futures speculators capitulate in panic. They purchase metal precisely when their production schedules demand it. That behavior establishes a natural floor beneath price, but that floor is anything but smooth or predictable. Here lies the concealed danger. Market participants hear supply deficit and automatically assume price should grind steadily upward. Silver never behaves that way. When supply tightens, but available liquidity thins simultaneously, price behaves like liquid forced through a constricted pipe. Pressure accumulates behind the obstruction. Then it either surges forward explosively or drops suddenly when flow patterns shift. This explains why silver frequently appears most vulnerable immediately before it strengthens again. Now examine this year against last year through this lens. Last year, industrial consumption was rising steadily, but existing inventories still provided system cushioning. This year, that cushion has worn dangerously thin. Global silver stockpiles are not collapsing entirely, but their distribution has become severely uneven. Certain regions face tightness, others maintain comfortable levels. That geographic imbalance matters exponentially more than aggregate supply statistics. Markets do not price theoretical totals, they price immediate availability in specific locations. When metal sits stored in the wrong geographic location, price reacts violently to even modest shifts in regional demand patterns. This explains why silver volatility remains stubbornly elevated even following sharp corrections. Another documented factor involves mining production specifically. Silver mine output has not surged upward to satisfy climbing demand. The vast majority of silver emerges as a byproduct during copper and zinc extraction. That means silver supply cannot respond quickly to higher price signals. This reality is absolutely critical to understand. Even if silver rallies dramatically, new production capacity does not materialize immediately. That keeps long-term structural pressure firmly intact. But once again, this offers zero protection for short-term position holders from experiencing severe pain. Supply tightness functions like a rubber band stretched to its limit. It stores tremendous potential energy. It does not control when that energy releases. Kiyosaki's prediction fundamentally leans on this long-horizon supply narrative. And that narrative is not built on fantasy or wishful thinking. But where market participants get devastated is assuming supply tightness guarantees near-term upward momentum. It absolutely does not. It guarantees amplified volatility in both directions. This is why silver's violent drops feel so intellectually confusing to holders. People naturally expect tight supply to function like protective armor. Instead, it functions like accumulated tension-seeking release. The tighter the physical system becomes, the more explosive the price movements. Now layer in another verified dimension. Silver inventories held in major global trading hubs have shifted substantially across recent years. Metal has migrated toward geographic regions, offering higher premiums and demonstrating stronger demand signals. That migration creates concentrated stress points within the system. And when one hub experiences tightness, price responds on a global scale, even if alternative hubs still maintain adequate metal supplies. This is why silver operates like a structure with multiple vulnerable joints. Complete system failure is not required. One overstressed connection point is sufficient to trigger violent movements. This also explains why silver frequently recovers faster than observers anticipate following sharp declines. Once forced liquidation exhausts itself completely, no equivalent downward force remains active. Physical buyers step forward into the market, not emotionally, not speculatively, practically. They do not chase rising prices aggressively. They wait patiently for weakness to materialize. This is where clarity becomes essential once again. A violent drop followed by stabilization does not signal danger has completely passed. It signals the market is undergoing necessary recalibration. Recalibrations consume time. They frequently involve multiple directional swings. Silver rarely transitions from excess directly into sustained calm. It oscillates repeatedly. This is why warnings carry weight at this precise moment. Not because silver's fundamental story has broken, but because silver currently operates in an unstable state. Unstable markets punish impatience mercilessly. Compared to last year, silver offers far less forgiveness to positioning errors. Compared to yesterday's session, silver may appear deceptively quiet, but quietness in silver frequently precedes significant directional movement. This is where analogies provide valuable clarity. Silver right now resembles a tightly coiled spring bearing uneven load distribution. Certain pressure has been released through recent volatility. Not all of it. If traders lean against it without understanding precisely where remaining tension concentrates, it snaps violently. This is why predictions delivered without proper context become genuinely dangerous. They fixate entirely on destination while ignoring treacherous terrain. The long-term fundamental case supporting silver can remain completely intact, while the short-term trading experience proves absolutely brutal. That is not contradiction. That is simply silver being silver. At this critical juncture, the most catastrophic error involves searching silver charts for answers they cannot possibly provide. Silver does not telegraph what happens next in predictable sequences. It reveals where systemic pressure is accumulating beneath the surface. That distinction matters enormously right now. If Robert Kiyosaki's bold forecast accomplished anything meaningful, it illuminated just how extreme market expectations have grown. Not incorrect, extreme. Extreme expectations fundamentally alter participant behavior. Altered behavior restructures risk architecture completely. That represents the genuine signal worth monitoring. Right now, silver is not determining its ultimate price destination. It is determining how much speculative excess requires purging before sustainable movement resumes. This is why the approaching phase is not about ambitious price targets. It concerns itself entirely with market reactions under pressure. Observe how silver responds specifically on declining days, not advancing days. Does selling intensify immediately and cascade, or does it stall quickly and fade? That behavioral distinction reveals whether forced liquidation remains active in the system. Monitor transaction volume closely, not sensational headlines. When price shifts dramatically but volume contracts, it signals participant exhaustion. When both surge together simultaneously, instability continues festering. Another critical indicator involves recovery velocity. In healthy yet volatile markets, silver rebounds swiftly from sharp declines. In unhealthy environments, it drifts lower gradually without conviction. Currently, rebounds exist, but display uneven character. That suggests the recalibration process remains incomplete. This is not a bearish assessment. It is an unfinished process still playing out. Also track gold's behavior, but do not expect silver to mirror it precisely. Silver frequently diverges from gold during acute stress phases. Gold absorbs fear and uncertainty. Silver amplifies both exponentially. If gold stabilizes while silver continues oscillating violently, that does not indicate silver weakness. That indicates silver behaving exactly as its structure dictates. This is where numerous holders misinterpret market signals completely. They assume silver must confirm gold's directional bias. It does not operate that way. Silver leads emotionally and lags structurally behind gold. That is why its movements feel exaggerated and disproportionate. Another practical warning involves temporal expectations. The most financially painful losses in silver typically stem from impatience, not incorrect analysis, entering positions too aggressively immediately following rally phases, or exiting positions too emotionally immediately following sharp drops. Both mistakes occur when expectations race ahead of underlying structure. This is why bold predictions from influential voices require careful interpretation. They are not detailed roadmaps. They function as stress tests, revealing positioning quality. They expose who maintains rational positioning versus who chases momentum blindly. Silver exposes that critical difference faster than virtually any other tradable asset. Right now, silver is testing discipline above all else. Not belief systems, not conviction levels, pure discipline. If someone holds silver positions today, the most valuable skill is not forecasting ability, it is restraint. Knowing precisely when not to act, knowing when volatility represents noise rather than actionable signal. This is where clarity cuts directly through the warning. Silver can still advance substantially higher over extended time frames. Nothing in recent price behavior disproves that possibility. But silver does not reward blind certainty. It rewards thorough preparation and adaptive positioning. This is not a market permitting participants to fall asleep at the wheel. And it is equally not a market justifying panic-driven decisions. It is a market demanding constant awareness and measured responses. The warning distills down to something elegantly simple. Silver carries immense power as both asset and metal, but it cuts like a sharpened blade. Handle it like a precision tool, not an unconditional promise. Those who respect its underlying mechanics survive its violent swings intact. Those who ignore structural realities become casualties absorbed into the reset process. That distinction separates survivors from statistics. And that is precisely why the conversation surrounding silver at this moment should not fixate on numbers alone. It should concentrate on observable behavior patterns, because behavior reveals more than any prediction ever will, and silver is monitoring that behavior intently. With that understanding firmly established, silver does not require hype to generate movement. It moves when accumulated pressure demands release. Predictions offer utility, but only when interpreted within proper market context. Right now, silver is not calm, and calm is not guaranteed to arrive soon. The mistake is not believing silver can climb significantly higher. The mistake is assuming the path forward will be comfortable or predictable. If someone is monitoring silver closely at this stage, maintaining focus on behavior rather than noise becomes paramount. Volatility itself is the signal. Discipline provides the competitive edge. If this analysis helped clarify the current market structure, ensure subscription is active, because silver does not offer second chances when it moves with velocity. Share in the comments which region you are observing from, and the tracking of what silver signals next will continue.